Hello everyone, my name is Paddy and I welcome you back to this channel. So over here, I help simplify financial and investment strategies and to help build wealth over time. In this video, we are talking about the investment community's wonder, or if you like, darling boy for the recent time, gold. And very quickly, I'm talking about why it is the darling boy and why anyone who is interested in investing or managing a portfolio should have some sort of gold or should hold something similar to gold. And most importantly, how to invest in gold for beginners. Then at the end of the video, I'm going to share my personal view or opinion about gold investments. Let's go straight to the video and understand exactly what I have for you today. Now, for the past 2 years, gold has appreciated by roughly some 115 to 120%. Everyone has got their own analysis on why gold has performed this well, but whatever the reasons are, it is no doubt that if you have held some gold in your portfolio for the past few years, this product has provided the necessary protection of your portfolio against all these current market shocks. So as there is a very high level of uncertainty in the market, people are running towards gold because it is a safe haven. It has been a safe haven for a long time, but in contemporary times, it has actually proven to be indeed a safe haven. All right, so this takes us to why you should hold some gold in your portfolio or something similar to gold. Now, this formula you see on the board here is what is known as CAPM, okay? And it is short for capital asset pricing model. Let's understand this formula quickly. All right, CAPM tells us that the return you expect on your investment depends on how much risk each asset adds to the portfolio relative to the movement of the overall market. Okay, and in this formula, as we will understand shortly, is what is known as beta. So imagine that you hold 4 different assets, okay? So asset 1 has got a beta of 2, asset 2 has got a beta of 1, asset 3 has got a beta of 0, and asset 4 has got a beta of -2. Now, this beta tells us how sensitive an asset is to the movement in the overall market. So what it simply means is that if an asset has got a beta of 2, this is twice as sensitive to the market. So if the market rises, let's say 1%, this particular asset rises about 2%. And the flip side of it is also true that if the market falls by 1%, an asset with a beta of 2 is going to fall by 2%. And a typical asset in this class is, let's say, crypto. Now, an asset with a beta of 1, let's make this the broad equity market. So this asset moves in line with the market. So we can say it is the market risk. And a typical example of this is the S&P 500. Now, an asset with a beta of 0, a neutral beta asset. Now, this asset is not affected by market movements at all. So normally, assets in this class are used for capital preservation, not necessarily for growth. It doesn't matter if the market moves up or down, this asset is not bothered at all. So let's say treasury bills, okay, we can say bonds. Our video is mostly centered around this area, an asset with a negative beta of 2, or it could be any number. Now, this asset moves strongly in the opposite direction to the market. All right, so if the market falls 1%, this asset tends to rise to about 2% because it moves in the opposite direction of the market. So what it does is that it is extremely defensive, mostly useful for hedging risk. All right, and this is where gold sits, and that is why I thought it was important to explain this. This always moves in the opposite direction to the market. Okay, so you need some gold in your portfolio to react as a shock absorber during the downturns, and that is why when the whole market is crashing, you often hear that the price of gold shoots up. Why? Because gold does not follow the market. Gold moves in the opposite direction of the market, and when the market is performing so well, it's either the price of gold is stabilized or sometimes moves down a bit. All right, so investing in gold is not primarily to make so much money, but to protect your portfolio. And that is why everyone needs something like this, something that has got a negative beta in their portfolio. The thing is, most people are not really interested in portfolio construction or management. They just want buy gold, hold it, and sell once the price or the value goes up. And if this is your strategy, it still applies, because in downturns or when the market is crashing, your profits maximize in such a situation because of its non-market correlative beta. This is the whole point on why you should hold something closer to gold. Now, let's get into the details of the video on how to invest in gold. So we are going to focus on three main ways of investing in gold as a beginner, all right? And the first one is the traditional method, that is investing in the hard or the physical metal. Then we look at the gold related instruments. So these are instruments that are designed to mimic the performance of gold, some of them having the backing of the physical or the bullion behind them as well. That is the gold related instrument. Then we talk about the digital gold or gold saving plans. So let's take them one after the other and understand exactly what they mean. So traditionally, this is the most typical approach to invest in gold is by purchasing the physical gold. And these days, you don't always need to hold the bars. You can get them in coins as well. All right. And I believe this is the most classic approach to investing in gold. So by buying the physical gold, you acquire a tangible asset. There's no two ways about that. You get to carry the physical gold in your possession. So this method carries no counterparty risk. There is no intermediary such as a company, a bank, or the government standing between you and your gold. Because of this, physical gold or physical possession is often regarded less as an investment aimed at generating returns and more as a form of financial insurance. And what this means is that, of course, if you have the physical gold, there is no one paying you any interest or dividends on top of that gold. Okay, so its main purpose here is to safeguard your purchasing power during times of inflation, currency devaluation, or financial uncertainty. And this method seems pretty simple, and it actually is, but of course there are some trade-offs to consider. You would need to think about a secure storage for your physical gold. You may also need to think about insurance and possibly paying premiums above the spot price when you are getting it. And the reality that selling quickly at the exact market price isn't always straightforward, and that some of the other methods that we are going to discuss. And that brings us to the second way through which we could invest in gold. And there are also three sub ways under this main one. We could invest in gold through gold ETFs or ETCs, through mining stocks, and gold futures. So let's understand what each of these means. So the first one, which is gold ETFs or the gold ETCs, these are investment funds that track the price of gold and trade on stock exchanges just like shares. All right. So most major gold ETFs are backed by physical gold or bullion held in a secure vault by custodians, all right, or the creators of these funds or ETFs. So meaning each share that you buy in an ETF represent a fractional ownership of that fund. So investors can buy and sell gold ETFs through the normal brokerage accounts without worrying about security or storage or insurance, making them a simple and a very liquid way to gain exposure to gold's price movement while you don't own the physical delivery of the metal or the gold ETFs. ETFs closely mirror gold prices, and they are widely used by investors to diversify portfolios, just like we explained earlier under the CAPM formula. Now, the benefit or advantage of having an ETF or investing in this is that it is highly liquid and very easy to trade. Like we said, no storage or security concerns here. Simple, efficient portfolio diversification strategy as well. All right. Now, the disadvantage of this is that in most cases, there are annual management fees or expense ratios that you will pay for the people managing the fund or who hold the gold on your behalf. The next sub-way under this heading is gold mining stocks. Now, when you invest in gold mining stocks, you are buying shares in companies that are involved in exploration, extraction, and let's say the production of gold. So these companies are listed on the stock exchange like any other company, and their shares trade like any other equity. Now, what you have to understand here is that since you are investing in businesses or companies, you get an indirect exposure to gold prices and potentially dividends, because they could be companies that pay dividends, which physical gold doesn't give you if you buy physical gold. However, it is also very important to understand that since you are investing in companies, company performance is another factor beside the gold prices. For example, management and operational risk, exploration success, right, potentially leading to more volatility volatility than the gold price itself. So here, your future returns depends on both the price of gold and the company's fundamentals or the company's performance. So that is mining stocks. And the next one is gold futures. So like we said, this video is how to invest in gold for beginners. So normally, this is not an ideal way to invest as a beginner because this is a highly sophisticated instrument. Okay, so these are exchange traded contracts to buy or sell gold at a predetermined price on a future date. So for example, if you go in for gold options, these options give you the right but not the obligation to buy or sell an asset at a specific price within a given time frame. So what it means is that if you believe gold prices will rise or fall, you can place a directional bet using call or put options. However, like I said, this is highly complex. It is risky and not suitable for beginners, but it is something you can read about to understand exactly how it is done. And as you become a professional, it is a way to invest in gold. Now, you can get, these instruments through a standard brokerage platform like Fidelity, Charles Schwab, or any other similar investing broker. Now, let's move on to the third and last one. So this is their digital gold investment. All right, this is quite a modern and a beginner friendly way to invest in gold, I have to say, and it is through the digital gold platforms. All right, now what these platforms do is that they allow you to buy and sell fractions of physical gold that are stored for you in a secure insured vaults. All right, so the ones that I use are stored somewhere in Switzerland, and I believe most of them are stored in Switzerland. Now you don't need to worry about storage, like I said, because they store it on your behalf or security, and you also don't have to worry about handling. All right, everything is done for you digitally. All right, now most of these platforms would buy back your gold anytime you wish to sell, so you don't have to worry about volatility or how you are going to sell your gold when you have to sell it. So it's just about having a platform and buying your gold, your digital gold. Okay, if you look at the advantages of this strategy, it has got very low minimum investment. You can buy as little as $5, $10, $50, as much as you can afford. It's very easy to get started, and you can also buy and sell instantly at current market prices. The disadvantages of this strategy is that also you don't have physical possession of your gold. So if you would want to wake up to your physical gold and kiss it and feel very happy, you can do that because they are stored digitally on your behalf. But of course, you have the account. You can always log in and out of your account, open your mobile app to see your performance or how well your investment or your gold is doing in line with current market price. Okay, so these are the three ways that you can invest, or you can easily invest in gold as a beginner. All right, so this brings us to the end of the video and my personal thoughts about gold investment. If you started the video, you should probably have an idea of where I stand right now. First of all, I think it is a hedging strategy. Okay, and as to whether investing in gold right now is a very good idea, I think it is, because gold's renewed relevance isn't accidental. The first podcast that I've recorded this year is about whether I also strongly believe that the world is facing an impending recession, and on top of my argument is the fact that we live in an environment that is highly indebted right now. Okay, the global debt is skyrocketing, which means that policymakers are very constrained when it comes to interest rates. Okay, because high debt means that we cannot have interest rate go any higher than it is right now. So if interest rates are supposed to come down some more, which is my expectation, then it means that gold will continue to be a safe haven. All right, adding rising geopolitical tension, I believe that if interest rates continue to fall, especially in real terms, then gold doesn't need any hype to rise. It simply needs the system to remain fragile, as it currently seems to be the case. This is my personal opinion. It is not an advice, all right, for anyone to buy gold or not, but I think that investing in gold right now is the best strategy, especially if you're looking at if you have a long-term investing strategy. Thank you very much for watching this video. My name is Paddy. Please don't forget to support this channel. Subscribe and like our video. You can also share it to others, and I will see you in the next video.